Imagine two buyers, same income, same job, same down payment. They both want the same house at the same price in the same neighborhood. One of them gets a rate at 6.4% interest, the other one gets a rate at 7.1%. Like I just said, same house, same deal, but over the life of that 30-year loan, that difference can cost the second buyer over $40,000. The only difference between those two buyers? Their credit score. I'm Scott Alfano, and this is Signed and Funded, the show that breaks down real estate from both sides of the transaction, because I'm a licensed agent in Seattle and a loan officer across the country. Today we're talking about credit scores, what they actually are, how they're calculated, and why they have more control over your real estate future than almost anything else. Let's get into it. Before we dive in, just a quick note on how my show works. Every episode, I cover one topic, start to finish, in plain English. No jargon, no fluff. So whether you're buying your first home, selling to move up, or building a real estate portfolio, you can search the library, find exactly what you need, and walk away knowing more than you did before you listened. Today's topic is credit scores, and I want to start by saying something that might surprise you. The number on your credit report matters more to a lender than almost anything else you bring to the table, more than your income, more than your down payment, more than your job title. That sounds intense, but once I explain how lenders actually use your score, it'll make total sense. More importantly, once you understand it, you can work with it. Let's start at the beginning. A credit score is a 3-digit number, usually between 300 and 850, that represents how reliably you have managed to borrow money over time. The higher that number, the better. The most common model used by mortgage lenders is your FICO score. And here's something that most people don't realize. You don't have one credit score. You have dozens of versions of your score across 3 different credit bureaus. You have Equifax, Experian, and TransUnion. When a mortgage lender pulls your credit, they pull all 3 and use that middle score, not the highest, not the lowest, the middle one. So if your 3 scores are 720, 705, 698, for example, your lender is working with that middle 705. Now, what goes into that number? 5 things, and they're not weighted equally. Payment history is the biggest factor, 35% of your total score. Have you paid your bills on time? A single late payment can drop your score significantly, especially if it's been recent. Credit utilization is next, 30% of your total score. This is how much of your available credit you're using. If you have a $10,000 credit limit and you carry a $7,000 balance, you have a 70% utilization, and that is hurting you. Most experts recommend staying under 30% and under 10% if you're about to apply for a mortgage. Next, the length of your credit history. That is 15% of your total score. How long have you had your accounts open? That's why I always tell people, don't close old credit cards right before buying a house. Even if you don't use them, they are helping your score just by existing. I have multiple cards that I opened in college over 20 years ago. I don't use them, but I make sure that they stay there because that 20-year average really helps out my newer cards. Next, your credit mix. This is 10% of your score. Do you have a variety of account types? Credit cards, car loans, student loans. Lenders like to see that you can manage different kinds of debt. And lastly, new credit is the final 10% of your score. Every time you apply for new credit, you get a hard inquiry hit on your report, and that can temporarily ding your score. So please, if you are looking to buy a home, if you're looking to get a mortgage, don't go open new cards, don't go buy a new car in at least the 6 months prior to planning on buying a home. One of the more common mistakes that I've seen buyers make is starting to get their furniture right before closing on a house. They'll open up that credit card, they'll set the utilization all the way up to 100% because they put some couches or some chairs or some new bed sets at 5 years financing and used up every dollar possible, and suddenly they could not close on that loan. Lenders will do a final credit check right before the end of the transaction to make sure that nothing drastic has changed. And many, many people every single year lose out on houses they were about to buy by doing just that. How your score affects your rate and your loan options. So now that you know what a credit score is and how it's made, let's talk about what it actually does in a real estate transaction. First, your credit score determines whether you can get certain types of loans at all. For a conventional loan, which is the most common type, you generally need at least a score of 620. But just because you can get a loan at 620 doesn't mean that you want to. The rate you get at 620 is going to look very different than the rate that you would get if your score was at 740, for instance. FHA loans, which are government-backed and popular with first-time buyers because of a lower down payment requirement, they allow scores as low as 580, and in some cases even 500 with a bigger down payment. So if your score is in that range, FHA might be your path into home ownership. VA loans for veterans and active military, they don't have a set minimum, but most VA lenders want to see at least 580 to 620. Now here's the thing I want to drive home, because it's the part most buyers don't fully grasp until they're sitting across the table from me. Your credit score doesn't just determine your rate tier, it determines your exact rate. Lenders price loans using what's called a pricing matrix. Your score and your loan-to-value ratio come together to determine exactly how much you pay for the money you are borrowing from the bank. The difference between a 679 and a 680 can literally be an eighth of a point on your rate. And the difference between 699 and 700, same exact thing. And these aren't arbitrary cutoffs, they're literally how the pricing works. Let's put this into a real numbers example. On a $450,000 loan, the difference between a rate at 6.5% and 7.0% is about $135 per month. Over 30 years, that's over $48,000. And the thing that determined whether you were at 6.5 or 7.0 is probably 30 to 40 points on your credit score. I've had buyers come into me that were frustrated because they got pre-approved somewhere else at a rate they didn't love. We pull their credit, I look at the report, and I could see immediately that 2 or 3 things are dragging their score down, things that are fixable in 60 to 90 days. Sometimes the right move isn't to rush into the market. Sometimes it is to wait 3 months, fix the score, and save $100 a month for the next 30 years. And going back to what we were just talking about, knowing how much something like your credit history, something like opening new accounts, affects the total proportion of your score, it helps us know what areas to attack first to impact your credit score the most quickly and get you back into buying mode. So, what do we actually do with all this new information? Let's make it practical. First, know your number before you start shopping. I can't tell you how many buyers come to me having already fallen in love with a house, only to find out their credit situation is going to be a problem. Pull your free credit report at annualcreditreport.com. That is the official government authorized site. You can also check your score for free through a lot of credit card apps or through Credit Karma. Personally, I use Experian.com. I check it almost every day. It's free. It doesn't cost anything. They have cost options. You don't have to use them. If you just want to see your main FICO score, check out Experian.com. Secondly, look for errors in your credit report. This is the one that people skip a lot, and it's actually a pretty big mistake. Studies have shown that a significant percentage of credit reports contain errors. Some of those errors are score impacting. Incorrect late payments, accounts that aren't yours, balances that are outdated. If you find something wrong, dispute it with the bureau directly. It takes a couple weeks, but it can move your score very meaningfully. Third, attack your utilization. If you have credit card balances, pay them down before you apply for a mortgage. Remember that 30% threshold. If you can get your utilization under that on every card, not just in total, you will see your score respond almost immediately. Fourthly, as we touched upon already, do not make any big moves. And I'm saying it again here because I do see it all the time. Don't open new credit, don't close an old account, and don't finance anything major in the 6 months before you plan to buy. New inquiries hurt your score. Closing an account hurts your score. The goal is to be boring with your credit while you're getting ready to buy. Fifth, talk to your lender early. And this is where working with someone like me, both an agent and a loan officer, does give you a real advantage. I can look at your credit report, not just to get you approved, but to see what specifically is keeping your score from being higher and what the fastest path to improving it may look like. Sometimes it's a $500 balance on an old card you forgot about. Sometimes it's a medical collection that can be handled with a letter. Every situation is different. The bottom line is this: your credit score is not fixed. It responds to behavior, and the buyers who understand that, the buyers who come into the process knowing their number and having a plan, are the ones who get the best deals. If today's episode was useful, the best thing you can do is hit subscribe. That way you'll get episode 3 the moment it drops. We're going to tackle something that goes hand in hand with your credit score: how much house you can actually afford. Not what the bank says you can afford, what you can actually afford, because those two numbers are usually pretty different, and knowing the difference can save you from a payment that you feel like owns your life after you've bought your home. You can find Signed and Funded on Apple Podcasts and wherever you listen to podcasts. Follow the show on Instagram at @SignedAndFunded for quick tips between episodes. And if you've got a question about your credit, about your pre-approval, or your real estate situation, please reach out. As I've mentioned before, I'm a licensed agent in Seattle, Washington, but I'm also a loan officer across the country. I'm happy to help you figure out where you stand and what your next move looks like. Thank you for listening to Signed and Funded. I'm Scott Alfano. New episodes drop every Friday, one topic at a time, so you always know exactly what you're getting. Until next time, go make a good move.